right, so on the Money Show, we make sure that we just don't talk about investing in mutual funds, but also help you meet the brain behind these funds. In this week's Meet Your Fund Manager segment, we have on board Rahul Singh, CIO-Equities, Tata Mutual Fund. Let's listen in to this interaction where we talk about the current market movement and your investment strategy, and also what's going to happen in the second half of this year. Very crucial period in terms of interest rate and inflation and your portfolio return. Let's check this interaction out. All right, welcome to the Meet Your Fund Manager segment today, and we have a very special person for this particular segment where we'll be talking about the market conditions and your investment strategies. I have Rahul Singh from Tata Mutual Fund Equity CIO. Welcome to the show, the Money Show, where we talk about investment strategies which are the best, looking at the current market condition. But then before we go into or deep dive into investment specific strategies, I want you to help us understand the current market breadth, where the market is range bound, looking at the global uncertainties. Even though we are strong at our own grounds, do you think the market is range bound and not as upbeat as it should be? What could be the reason behind that?
Thank you for inviting me to the show. I think the range bound movement is a result of the tussle which is going on between high interest rates and, generally speaking, positive economic fundamentals. When I say generally speaking, obviously there are ups and downs, but in general in India, the economic sentiment or the economic growth outlook is much better than it is in the world.
Okay.
But having said that, the interest rate scenario is still not settled.
Exactly.
We don't know whether there are any more hikes left, especially in the US, and what impact it has on the valuation, because equity valuations are inversely correlated to interest rates. And even though we are getting earnings growth, we are getting economic growth in India, overall there is a pull down effect from interest rates on equity valuations.
Right.
So therefore this tussle is going to continue till we are at the end of the rate hike cycle, which could take another 6 months, 12 months, difficult to say. But the good part is that the economy itself is going in the right direction. It's moving away from just being a consumption-dependent economy to consumption plus investment-dependent economy, and now exports also. Because India is getting a lot of attention for setting up export-led manufacturing units as the world tries to move away from China. So all this is creating a good, I would say, 3 to 5 year outlook from the economy perspective. But we have to live through this 1 year when the world is still not very, very settled in terms of the risks, in terms of the interest rates. So I think it's a process. We as fund managers don't mind this period of 6 to 12 months because it gives us also time to assess the risks and also buy the kind of companies we want to buy the kind of sectors we want to buy. So we are quite confident that this is eventually a period which will result in better returns subsequently.
So do you think this is a very sector-specific market or a stock-specific market when we talk about valuations specifically?
It is a stock-specific market now. There is a little bit of sector momentum up and down, which keeps happening. So today banking is looking good, capital goods, manufacturing, infrastructure is looking good. But barring if you leave these couple of trends, it's pretty much a stock-specific market now, and it will become more and more of a stock-specific market, which is again something which helps good fund managers do better than the market. It's already happened in the last 15-18 months. I think the same will continue in the next 1 or 2 months. Having said that, there are always some sector calls you can keep taking. For example, urban consumption is not looking the strongest, but even within urban consumption, you will find companies which are doing much better than the rest of the companies. So, end of the day, you can follow the sector trends, but ultimately you are having to choose stocks which we think are going to manage this situation better than the other stocks in that sector.
In last 6 months, if I have to ask about your funds portfolio, were there any major changes that you've adopted or you've gone through or you've initiated just to beat the kind of volatility or the uncertain times that we are now into?
So we've added, we've basically been positive on banks.
Okay.
We continue to follow that path.
Sure.
At every opportunity. Similarly, we were early in identifying infrastructure, capital goods, industrials as a space, manufacturing as a space where we have taken exposure across our funds. Some funds will have more than others, but generally speaking, that's been the trend. So these are the two things which we are obviously focusing on. We continue to be a little underweight on IT, which is something which we are still not clear as to when the sector will again start moving up. And in terms of the market capitalization, I think we are a little indifferent today whether it's a large cap, mid cap or small cap, because the way the economy is evolving, the investment, when the economy moves from just being a consumption to consumption plus investment, the market also broad basis.
Right.
And therefore you get more opportunities in mid and small cap to pick from. So we are today not very particular on whether we have to buy only large cap or mid cap, small cap.
Okay.
If we are seeing good opportunities, good companies, good managements in a good space, we are not really very worried about mid cap, small caps as a segment.
Okay.
In fact, even in the valuations, if you look at mid cap valuations are at a premium to large cap, but it nowhere near where it had reached in 2017, which was really a kind of a euphoric period. So we are in a period where we can be selectively looking at mid and small caps and not necessarily be very worried on that segment.
So the selective selection also includes having multi-baggers in your portfolio. What would be the criteria for selecting those multi-baggers, if I can call them that?
See, nobody knows multi-baggers till it actually happens.
Right.
So what we have to go for is there enough tailwinds for the company, if it's an average company. If it's not an average company, is the management good, is the balance sheet good, is the capital allocation good? And you back that. You back one of these two things. And that is how multi-baggers happen. It is not, at the beginning of the journey, nobody knows whether they are multi. Only at the end, you know that it was a multi-bagger. So we follow a very bottom-up GARP philosophy. So our philosophy at Tata Mutual Fund is growth at reasonable price.
Right.
So our starting point is valuation, but that's not the end point. The end point is growth.
Okay.
So how do we shortlist and identify companies which are reasonably valued, but which have a strong growth ahead of them? I think that's the essence of our philosophy, because if you pay a fair price for a certain asset or a certain company, the chances of you making above average returns go up.
Right.
Rather than when you overpay for that company, if it's a very expensively valued company.
Let's talk about crude and rupee. How is the movement? Is it really concerning you right now, the weakening rupee, and what levels in crude you think that we'll be comfortable now?
So we've seen $85, $90 and back. I think right now we are at a comfortable level. I think even if it goes up $5, $10 here, up and down, it's not going to change things dramatically. At the margin, it'll always start questions on, okay, whether the interest rates will now pause or go up, etc. Those risks keep going up and down. But as far as equity markets are concerned and earnings are concerned, crude has become less of a role to play if it's in this narrow band.
Okay.
So we are not worried about it too much. At the same time, if it crosses 100, if there is another geopolitical issue, obviously it's negative for the entire Indian markets. Not just on the profit growth, but on the valuations also.
Now, looking at the corporate earnings, which are expected to be muted, when you look at the forward-looking commentary, what are the points that you will be stressing on, or the points on your radar to make a strategy for your funds?
The strategy for our funds is very simple. So we follow growth at reasonable price as a strategy, which I think is something which is a strategy which works across the interest rate cycles, across the economic cycles. At some point of time when the interest rates were low, I think quality at any price, growth at any price, those kind of strategies started to do much better. But now we feel that valuation discipline has come back into the market. So that's point number one. Point number two is, like I said, the economy is moving from just being consumption to consumption plus investment. This is something which We have been waiting for last 10 years. That investment cycle revival is happening after 10 years. Whether you look at corporate investment cycle or household investment cycle, which is real estate basically. Both are reviving after a period of 10, 12 years. So we think there is some distance to go.
You think it's going to sustain? What are the factors that you are banking on?
Yeah, it is sustaining as of now.
Right.
We need to be watchful. One risk was that if interest rates had gone up too high,
Right.
then both the corporate capex cycle as well as the household investment cycle, which is real estate, would have not sustained that kind of growth.
Right.
But now that we are in a period where it looks like we should be near the end of the rate cycle, if not already at the end, that means that the interest rates will not keep on rising continuously on home loan rates and on the corporate loan rates, which gives the confidence that the capex cycle and the investments into real estate and sectors which had not done well will continue to sustain that growth. Because one of the big factors which is driving the growth in some sectors is also the fact that there is a lot of investment coming into India as an alternative to China over a 5 to 10 year period.
Yeah, okay.
For various reasons, mainly for geopolitical reasons. And that is a trend which can last for 5-10 years. Now within that, can everything go right? Everything need not go right. There will be things which will go wrong. But this is a huge kind of positive factor for Indian investment cycle, which we cannot ignore now.
Right.
We could have ignored it 1.5, 2 years back, but definitely not now. And therefore, interest rates could have spoiled it. Now it looks like stable, but can something else spoil it? There could also always be risks.
Exactly.
There will always be risks.
Yeah.
Political continuity is one risk. So we need to be watchful and be nimble if that happens. But so far, things seem to be falling in place.
Talking about China, you think them picking up their economic activities and raising their growth could be a spoiler for us, or you think that we've established ourselves really well when it comes to being replaced by China?
So I think economic growth in China was also export driven. A lot of it is export driven, and it's slowing down. Similarly, there also, I think the government is more focused on common prosperity and not
Right.
just unequal prosperity.
Okay.
And there is a certain amount of, I won't say negativism, but certain amount of neutrality towards necessarily showing very high growth. So their growth targets are 4.5% GDP growth rate for the next 10 years. So they're very clear on that. I think yes, there could be short-term lifts like post-COVID when China unlocked, there was some capital flow which went there, but those are very, very transient.
Okay.
If you take a 5-year view, I think the trend is very clear that they are happier with slower growth today than they were, say 5 years back. And that's indirectly good news for India.
To our investors, time to rebalance your portfolio and time to pump in as much money as you can, especially if you have a 10 years horizon or a 15 years horizon. How should one go about?
See, it depends on two objectives. One is how do you manage this period of heightened risk in the global markets. So then you keep the asset allocation healthy between debt and equity. And today debt is also earning decent returns. It's not the 5.5% return which we were earning 2 years back.
But you can still go heavy in spite of debt giving you good returns.
Yes.
On equity.
Yes, you can still. And also it depends on the personal situation. So depending upon what is your income level, how secure is your job, how well you're doing, how old are you, how many dependents you have, you need to be conscious of all those factors when you decide the debt and equity allocation. So there's no one single answer for a question like this.
Right.
And one of the products, for example, we have, which I always recommend, is the balanced advantage funds, because it takes advantage of the volatility in the equity market and also gives you some debt exposure all the time. So you are not missing out on that part if the yields go up. You're also not missing out on volatility in the equity markets. You can take advantage of the volatility, in fact. So that's one product which kind of navigates this situation quite well.
Personally, and last question to you, this is, personally, are you an aggressive investor or a conservative investor or somewhere in between?
We have to be, we have to play to the needs of that fund which we are managing. So for example, if I'm managing a small cap fund, I'll have to be slightly more aggressive than when I'm managing a balanced advantage fund. So again, I would not, there is an inherent personality which everyone has, but at the end of the day, you are managing certain kind of fund mandates.
Right.
And you have to navigate and tailor make yourself a little bit to align to the objectives of that fund.
Right.
I cannot be very aggressive in a balanced advantage fund in my equity allocation, and I cannot be very conservative in a small cap fund.
Yeah.
I can be quality conscious, I can have my parameters, but I cannot be very conservative. So that's how I would, that's where I would leave it.
All right, I think that will be all. Thank you so much for removing time for us today. Thank you. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. So, fixed deposit is trending. Banks are coming up with special fixed deposit rates for specific tenures. So, how should you as an investor make the most of these fixed deposit rates? Let's welcome on board Hemant AR, AVP Communications, bankbazaar.com, and take this discussion forward. Hemant, good evening and welcome to the show. So, it's raining fixed deposit, if I can say, and that too for specific tenures. Why is it that fixed banks are coming up with such attractive rates for 1 to 3 years period? What could be the reason and trigger for that?
Good evening, Kavita. So this trend we've been seeing for a while, basically the best rates available in the market right now would be typically in the 14 months to about 2.5 years range. This basically means that your best returns on fixed income are going to be in that 1 to 2 year range. The rates on 5-year deposits and deposits of longer tenors don't have such high rates. And this is basically because, the rates have been going up because of the changes in the repo rate in the last 1 year or so. The rates were slow to catch on last year. The deposits were priced around 4 to 5% last year, about a year ago. But now these rates are going up really rapidly. The banks have decided that the best value for money at this point in time would be in this tenor. I think it would be difficult for banks to lock into very high rates for 5 to 10 year periods. And that is why you see that, these 1 to 2 year tenors have the highest rates right now, Kavita.
Hemant, are you also talking about PSU bank, private banks, NBFCs, and small banks especially, where we are seeing really attractive interest rates?
Correct. So I'll answer this in 3 parts. One is that, the very large banks, these would be the government banks and the large private banks. They have come out with special tenors where the rates are between 7.5%. Then there are smaller banks, the smaller private banks, where you would find rates between 7.5% to 7.9%. And then you have the small finance banks where the rates have exceeded 8% in some cases. In fact, in one case, we are seeing that the rates have reached 9%. From a macro standpoint, I hope the rates don't continue going up this way. And I feel like, if you want to lock into these tenors, 7.5%, it's a good rate to have. There are banks that are offering, 6.9. I can cite 2 large private banks that are offering 6.9 for 5-year tenors. I think those are good rates, if you want to lock into them.
All right, but then looking at all the fixed income options, Hemant, do you really think one should be making use of these fixed deposits for a small tenure or maybe up to 5 years? Does it make sense? Because we obviously had one option of a debt mutual funds, and if one doesn't want to take that anymore, looking at the taxation benefit that's gone out of the window, is fixed deposit the most viable and attractive option for them?
Why do we use fixed deposits? There could be multiple reasons. I could give you my example. I would like to keep some part of my holdings in cash, essentially as an FD. to withdraw in any emergency. That could be a health emergency or any other emergency where I need cash immediately. Now, from my standpoint, if I have to look back at rates in the last decade or so, I don't think I'm going to get much better than 7.5%. So for me, I feel like it makes sense to lock into those rates for the longest available tenor, because I don't see the rates going too far up from this point. Uh, on the other hand, you also need cash for short-term considerations. For example, you might have some planned event coming up. For example, you might be buying a car or a home, and you have decided that 1 year from now you need that cash. In that sense, it doesn't really matter what the rate is, because you would withdraw that money in any case, whatever the rate might be. And that is why you should prioritize the tenor of the FD rather than the rate. So those would be my 2 points. Basically, if you have emergency cash where you don't know when you would require that money, you could go for long tenors. And if you need that money immediately, then don't look at the rate. You could just look at whatever viable tenor there is for you, Kavita.
All right, but then the question comes now is, do we see these kind of attractive rates on fixed deposit only till maybe the first half of this year, and once, because a lot of reports and a lot of experts say that in the second half of this year we might see a rate hike pause, or maybe there could be the trend opposite. You think this is the time when you should really make the most of it and not wait for some more time?
Absolutely. I mean, that is what I have done personally, and this is the advice that we are giving at Bank Bazaar, saying that the rates might not get too better from this point. So we might be somewhere close to peak rates. And if you're getting peak rates for, let's say 36 months or 48 months or 60 months, it's to your own benefit. The rates that we have just talked about, those would be for the general depositors. For senior citizens, you can expect 25 to 50 basis points higher. And if you're a super senior citizen, which would be somebody above the age of 80, some government banks are even offering, an additional 25 basis points. So, these are very good rates for you to lock into for whatever term you want to be locked in. So yes, make the most of it. There are special offers going on. Now, the special offers would be something like, a 10 additional basis point on like a 44-month tenor. What we are seeing is that, a 10 basis point or 20 basis point difference in those rates would not make a huge difference for you in terms of returns. If you have an FD and you have the option of 7.6 or 7.7, it's not going to make a massive difference for you in terms of returns. So just look at your own requirements, when you need that money, what rate is acceptable to you, how long you want to be locked into that tenor, and just make the most of these rates.
Corporate FDs at the current moment attractive, Hemant, and how can one figure out what's the best corporate FD for them?
The AAA rated FDs are doing, they're offering close to 8% now. They haven't hit 8%, but, there are options like Bajaj or Sundaram or LIC, Mahindra. These are getting close to 8% now, 7.75 to 7.95. And a lot of these are on, 44 months, 48 months, 60 months, and so on. There are special tenors being offered. HDFC is also somewhere close. ICICI is also somewhere close, just under 7.5, I believe. So again, the ratings of these companies is AAA. They have an excellent track record in managing depositor money. So yes, so looking at those ratings and their track record, I think, at least you should get some exposure to these FDs if you want to improve your average FD returns, Kavita.
All right. Anything specific for senior citizens that one must be taking care of?
It's a open-ended question. There are lots of considerations here. I think the primary consideration would be the safety of capital. The guardrail that we often refer to is the DICGC limit of 5 lakh rupees, which is the deposit insurance. Some banks are safer than others. although RBI has a great track record in managing these banks in terms of regulation, I think it's always sensible to adhere to that 5 lakh or deposit insurance limit in your considerations, especially when you're seeking higher returns while going with smaller banks. Apart from that, uh, if you look at senior citizen rates for the long term, 5 to 10 years even, some banks are already above 7%. And we feel like those are good rates to lock into for the long term. I think senior citizens should look at those rates and make the best of them. It's quite possible that during the course of this year, interest rates will reverse and start falling. So then it will be a missed opportunity. So yes, make the best of those rates, Kavita.
I think that will be all. Thank you so much, Hemant, for removing time and helping our viewers as to how can they strategize their investment in a fixed deposit right now. Alright, welcome back. You're watching The Money Show with me, Kavita Thapliyal. So let's now shift focus to AMCs and their investing styles. Remember, every AMC has its own set of investing philosophies and strategies which determine the performance of a fund. So how do India's top 5 AMCs invest? What is their investing mantra? All of this we will get you, but then let's also understand the basic investment styles, on the basis of which, whether it is AMCs or huge investment names, what is the kind of strategy or investment styles do they follow? So usually what we all know about is value. That is one very important or a very famous style of investing. There is growth-oriented investing, sector-specific investing style, where you will see a lot of investors focusing on specific sectors. You'll be having index investing style as well. But then when we talk about an AMC, when we look at from a AMC perspective, how exactly an AMC changes their investment styles or their investing style, how can they incorporate all these investing styles in one particular fund maybe, or in their different funds? And also, do these investing styles vary from time to time as the market move? We have to understand all of these, because based on these understandings, you can have a portfolio or maybe a fund from that particular AMC that matches with your investment horizon, which matches with your risk profile, and also the kind of goals that you have lined up for your investment portfolio. So understanding investment styles are very important, not only from an AMC perspective, but also understanding what kind of an investor are you. A lot of times what we do is we just accumulate a lot of stocks in our portfolio. We accumulate a lot of funds in our portfolio without having any idea of being well diversified, or a lot of times we realize that we are over diversified across market caps. So understanding investment styles helps you as an investor to have a matured approach to your portfolio. And also a lot of times people who are traders also tend to become investors, if at all they understand these kind of investing styles. So we will get you we'll get you a run up on all these things, and also tell you what all of these investing styles actually mean. So if you look at the growth style, growth style has companies, they invest in companies with high earnings growth, with very high potential. And before that, so we will get you all this with Feroz Aziz. But then before that, Rahul Chadda, Investment Officer, Mira Asset Global Investments, believes that the next few months will be very challenging for the markets. So let's listen in more of these views on the markets, and also select on sectors.
I think next 3-4 months would be challenging, and I think we saw that in IT services result, where there is a sharp demand slowdown which has happened in recent months, and I think it continues. US economy is slowing further, and likely that probably around fourth quarter of this year or first quarter of next year goes into a mild shallow recession. So I think that is where the slowdown is going to come in the Indian economy also. That's largely going to come from weakness in exports, and that impacts the job creation around it.
What should be the best investment strategy? There is a visible fear in IT, but there is a visible growth in banking. There is a visible slowdown in rural India, but there is a visible uptick in urban India. What is the best way to stay put in this market?
I think the best way to stay put is take a medium-term view. Look, near term is going to be challenging, but that is where you get entry points. Most of us been saying that for a while, but look, in markets you don't make money every day, every month. You make money in spurts, and this is what we've got to understand. But if you're not positioned for it, you miss those spurts. And I think somewhere those moments are going to come.
All right, that's the view from Mira Asset India. But then we have Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth, with us. Feroz, good evening. Welcome to the show. We are going to focus on different investing styles that AMCs follow. But before that, can you just lay down the kind of investing styles that are normally followed or are the existing investment styles?
Yes, Kavita, like you rightly pointed out, several asset management companies in their business, about 40 odd of them. And if you look at the styles each of them will follow, are going to be diverse. So let me lay down a few of them which are quite prominent. This is not it's not an exhaustive list of styles, but still some prominent ones which have meaningful assets. When you look at one kind of style, which is valuation based, there are two categories in that. One is a value fund or a value style or a growth style. A value style is to buy businesses which are cheaper today, may not be the darling of the market currently, but they are inexpensive, in the hope the fund manager buys those that in the future, when people realize that this is coming at a reasonably attractive price, people will buy it, and that's when the fund manager will make money. That's the value style of investing, buying cheaper businesses, which may not be the ones which have done too well in the past. That's value style. Then on the contrary, the diametrically opposite end, which is the growth style, which as the name suggests, is buying stocks which are growing very well, may be expensive today, may not sometimes even justify the value, but they're growing so beautifully that the earnings will actually catch up with the valuation. That's the second thought process. That's the next school of thought. So value fund and a growth fund are funds which encompass these two distinctly different, diametrically opposite styles. That's two of them. Then if you look at the third style, which is again prominent, which is sector-based investing. So sector funds, which invest in specific sectors like a pharma fund, a banking fund, an infrastructure fund, which is a little broader sector. So these are sector funds which buy stocks in similar businesses. So that's the third style. The fourth style of investing is quite popular globally, which is the index investing, where the fund manager tries to not use too much of his or her judgment, but tries to replicate an index. So efficiency in implementation and execution becomes the mandate of the fund manager rather than trying to beat the index. So four distinctly different styles, value and growth, one kind, sector and index, the prominent ones which have gained momentum in the recent past. Could be four, which I thought I should touch upon.
So Feroz, talking about these investing styles and the kind of strategy these AMCs adopt as to reflect these styles on their funds, how does it happen? Because at one point in time, you can have different types of styles depending on the kind of fund you're managing or you have to offer to your investors. And these investing styles also change as per the market momentum. So we just cannot say that a particular fund will have an investing style all throughout its journey.
So with Kavita, the answer is yes and a no. Some funds in their own mandate are so clearly defined that they follow the same style till eternity. Some are not. Like, for example, a sector fund is going to be a sector fund today. It's going to be a sector fund 10 years from now because the mandate of the fund is so restrictive that they're going to invest in a banking sector fund, for example. If the name itself compels the fund manager to stick to the style, then that's going to be till eternity, unless the objectives and the key information memorandum goes through a change. That's point one. There are some funds which follow a style out of choice. Like, for example, a large cap fund can follow a value philosophy or can follow a growth philosophy. They're not actually binded by the principle of the fund or the objective of the fund. That is their own style. For example, like Prashant Jain, who was a very prominent CIO of HDFC for decades, had a blend of value philosophy in his style. So if you look at HDFC FlexiCap, HDFC Equity, most of HDFC funds had a rub-off of the CIO that he likes to buy cheap businesses. He is very price sensitive. So that was out of choice. So HDFC FlexiCap could choose a value or a growth, because it's not mandated by SEBI that you will choose any of these. So if that choice is of the fund manager, then the styles as per the contemporary market situation could undergo a change. You might buy a fund which was value when you entered. When you exit, the fund manager changed it to a growth principle. So that's how this sometimes is fluid, sometimes it's hard-coded.
Can an investor at an individual level have any of these investment styles? Do you think that's good for them, or investors should clearly just have a very financial goal-based strategy for their portfolio?
See, Kavita, in my opinion, managing money is a two-dimensional thing. One is internal, the other is external. It is not either or. So if you have a goal-based investing, that's more internal, trying to make sure that you have your objectives written down, what's the kind of savings you will have to have, what the kind of asset allocation you will have to have. All that is derived out of your current status, which is what the personal aspect of personal finance comes into picture. The second part is the finance of personal finance. Finance is a mathematical subject. So in certain periods of markets, a certain style does better. For example, in 2021, beginning of 2021, we have had a clear vision at Anand Rathi Wealth that value will do very well. And that actually transpired to be that way. So HDFC FlexiCap came into our recommendation, and it generated an alpha of almost about 20% in the last 2 years over Nifty. But the previous 5 years, value was a principle, didn't work at all. So to answer your pointed question, both are critical. One is an internal variable, which is the personal side of personal finance. And the second is the finance side of personal finance, requires having a two-dimensional strategy, not just unilateral.
I think that will be all as far as this topic is concerned of investing styles that AMCs adopt. But we have a lot of queries lined up for you, Feroz, and we have our first caller, Mr. Avadhoot Kulkarni from Kolhapur, Maharashtra, who wants to ask his question. Mr. Kulkarni, hi, good evening. How are you doing, sir?
I am fine, madam. How are you?
I'm doing good, thank you. So you have PGI Mid Cap, Canara Robeco Large Cap, Nippon Small Cap in your portfolio, right? And you want to hold these funds for 20 years?
Yes.
And what is the corpus that you're looking at for retirement?
Near about 50 lakhs.
Will that be enough for you?
Yeah, I hope so. Yes.
Okay, so I think we'll get the calculation on that also from
Yes.
Feroz. But then, do you want to increase your SIP amount? Will you be able to do that as and when it's possible for you?
Yes. I target by 30% per year.
Oh, 30% per year. Okay, that's a good amount. All right. So Feroz?
Yes, I think Kavita, you pointed the question in the right direction in terms of, will that be enough? Will 50 lakhs be enough 20 years from now? To my mind, definitely not. If a person can actually save 10,000 rupees per month today, 50 lakhs for retirement will certainly not be sufficient after 20 years, because the value of 50 lakhs after 20 years, please assume that to be 1/4. So it's like 12 lakhs today. Would Mr. Avadhoot retire with 12 lakhs today? I don't think so. So try and revalidate that number, because every 10 years, the value of money at a 6-7% inflation becomes half. So in 20 years, it becomes 1/4. In 30 years, it becomes 1/8. So that's the basic thumb rule you should look at. So 50 lakhs 20 years from now is just 12.5 lakhs, which is 1/4 of 50 lakhs. Now, if I gave you 12.5 lakhs today, would you retire? I doubt that, right? Your expenses are going to definitely be significantly more than your retirement could actually sustain at a 12.5 lakh corpus. So that's one. Second, I'm very, very thrilled to hear a number of 20 years kind of investing timeframes. 5 years back, you would not have callers who say 20 years as their investing time frame. So I think great, Kavita. I think education at your end has helped people look at long-term, truly long-term. Now coming to the schemes which you hold, Mr. Avadhoot. So I think two of them deserve to be a part of your portfolio. One thing which can go on the annual for an exit whenever appropriate, you would be the best judge in terms of exit loads and tax implications of the decision. Canara Robeco Blue Chip Equity could be an exit. Instead of that, I can give you a lot of funds which which in our opinion have a forward-looking, prospectively looking great future. And given the fact that you're able to increase your SIP amounts by 30% every year, you may need a few schemes. So let me read out about 3-4 from the list of 8 which I see. HDFC Flexi Cap, ICICI Focused Equity, HDFC Small Cap, SBI Large and Mid Cap, SBI Contra, and Franklin India Blue Chip. These are some of the schemes which you can add to your portfolio as and when the amounts become large enough.
All right, with that, we move on to our next question from Brijesh. It's via email, and he says that he's 48 years old and he's an NRI and planning to retire at around 55 or early. And he has some fixed deposits and another 75 lakhs invested in stocks, and investment advisor has been asking him to sell the funds invested through broker or invest them directly. Now, so he's confused basically in order what kind of an approach he should be taking on, and we don't have his exact portfolio details, but then what would you recommend, Feroz?
See, I think, Kavita, this is a larger debate in terms of should I go direct or regular. See, if you're as a client, if you've made your choices of the schemes, and if you think you have the capability of being able to monitor and make changes in the funds which are there a part of your portfolio, then you can go direct. But if you think that somebody can monitor it, make changes timely, because you can be married to equity as an asset class for 10, 15, 20 years. But you don't have to be married to a scheme beyond 2-3 years, because the scheme's job is to deliver excess returns over the equity returns of Nifty, let's assume, if that's the benchmark. Now, if you look at our model portfolio for the last 9.5 years, have gone through a reasonable number of changes, 38 entries, 36 exits. And that's why 3.2% of alpha over Nifty year-on-year compounded has been generated. Because quite a few schemes who do well in the past don't do well in the future. And the best and the worst scheme have a difference of 30% every year. So if you believe that you can do it yourself, look at the shows in terms of electronic media. The Money Show can give you a lot of guidance. As long as you're going to be on top of it, go direct, save that 1% cost. If not, I think it's better to have an advisor or a distributor who can monitor and make changes timely.
That, Feroz, it's time to wrap up. Thank you so much for being on the show and helping our viewers with every aspect of their financial planning. And before I sign off, I'm going to leave you with our WhatsApp number and email ID where you can send us your portfolio-related queries, but also do send us your portfolio details. Thank you so much for watching. Goodbye.